Hello and welcome to this video on putting it all together. We're going to be taking the ability to create trend lines, create levels of support and resistance, and identifying trend direction to create what is called swing trading strategy, as well as a breakout strategy. Now, these two different strategies are different types of trading that utilize and take advantage of different types of market movements basically within the Forex market. So as covered before, levels of support and resistance offer a really good way to trade breakouts. You basically draw a level of support and a level of resistance, and depending on how these levels are drawn, whenever the market breaks out in one direction or the other, that's when the trade would be taken. You would be looking to ride that breakout to either setting a new trend or for a short-term gain. Swing trading is a little bit different. It actually takes advantage of the trend itself to allow you to get into a move and stay in the move for as long as possible. Now, the difference really between the two is breakouts look for one specific point, one point that either comes down to breaking the support line or resistance line, or news release, a fundamental analysis, something like that, in order to actually take a trade at a specific level and a specific point. And usually breakout trades, you go for a certain amount of pips or ride it until the move begins to slow down. And swing trading, on the other hand, is a longer term situation. It's a longer term method of trading that's using all of the information that we gathered before, such as trend direction, levels of support and resistance, moving levels of support and resistance, um, and basically what is the overall trend in order to take swing trades, which is basically the old proverb, buy low, sell high. It actually gets its name from these swings, or the retracements in price that we covered in a previous lesson about trend formations and lines of support and resistance. You got the thrust, which is the push up in the direction of the trend, and the recovery, which is the counter trend. It basically goes back in the other direction just enough in order to hit the other side of your trend lines, and then it continues on in the same direction. So while these lines of support and resistance are very good in determining when you should get in and when you should get out of specific trades, you can actually use some of the more popular indicators, as we'll go over here in a minute, to help you with your entries and exits and make the most out of your swing trades. A lot of swing trades have you holding your position depending on the chart that you're on. The example that we'll be using, I'm actually on a 4-hour chart currently, but many of the swing trades that you do take will have you hold on to this position for days, and it could be even measured in weeks at a time. Basically, as long as it takes for you to ride the swing from one defined point of entry to your defined point of exit, which is usually either the other side of the trend, or whenever an oscillator like a stochastic or a moving average helps you to determine when to exit after you've gotten as much out of the trade as you possibly can. Now, the benefits of swing trading is not a lot of people have a whole lot of time during the day, unless you're a professional trader, to sit behind charts, do a lot of day trading or scalping or trying to get in and out of the market really quick, which is something that a breakout system would afford you, especially on news days. Now, swing trading allows you to see your setups in advance, allows you plenty of time in order to determine when your entry and exit's going to be. There's a whole lot more planning that goes into swing trading, and there's a whole lot more holding onto your position, but it also affords you the ability to pull more pips out of the market and actually stay in the market a little bit longer. Since you're going to be using higher time frames with your swing trading, the distance between your support and resistance levels is going to be much bigger. So once again, that adds to the profit factor, the ability to actually have some more profit come out of your trade, but it also means you're going to be in the position for a longer period of time. And it's generally the preferred method of trading for those who are doing it in their spare time or only have a certain amount of time during the day to look at markets and set up their trades. Definitely a few advantages to swing trading. You have, once again, bigger profit potential. You're looking for larger runs in price. And it's basically just a longer term version of what a day trader would be doing in a day-to-day trading scenario. And once again, you have a lot less time trading whenever you do swing trade. So the benefits for the average Forex trader is someone who's just getting into it as a hobby, or somebody who's getting started, or even someone who's very advanced in their trading. It's just looking to supplement their trading with a longer term system, or using it to hedge their shorter term trades. It affords swing trading all sorts of additional opportunities and upsides. And obviously, with swing trading, there's a lot less um, a lot less stress involved, if you will. You're entering and exiting a lot less. You're actually paying your spread less. And if you're holding it over a period of time, then, if you scale your lots down, it allows you to place all of your trades, do your trading, but at your own pace, if you will, especially since it's a 24-hour market. The market is constantly moving. I've known some swing traders, to only check their charts 2, 3 times a day, if that, uh, considering they have a longer term strategy in place. And the best swing trading strategies definitely employ the ideals of support and resistance that we had followed, and identifying the trend. So let's take a look at a nice swing trading strategy. It uses a couple of indicators and a couple of trend drawing techniques. The first indicator that I'm going to be using with the system is the stochastic indicator. This is called an oscillator. And basically, the whole premise behind it is that you've got a line that is based off of momentum in the marketplace, and is basically a line that's showing you the similarities between the location of the close. You remember the close of the candle versus the high and the low. So as the candle, or as the price, pushes quicker or slower in a certain direction, it's going to actually pull the stochastic either higher or lower. One of the benefits of stochastic is the fact that since it's momentum based, it has the added advantage of having a kind of a leading effect to the market. So momentum, by a fundamental rule, really changes direction before price does. So the stochastic oscillator is going to afford us the ability to not only see defined entry and exit points, but it's also going to kind of lead the market a bit and tell you beforehand which direction the market is going to head in junction with the trend. And let me show you what I mean. There's actually a really clear example here. You'll notice on the chart, we've got a point right here, and this corresponding point on the stochastic is right here. Okay? And you'll notice on the next peak of the stochastic, which is here, we've also got another peak on price, which is here. Well, notice something very interesting. The stochastic is moving in an upward direction, while the price is moving in a downward direction. And this is what we call divergence. Since stochastic is a momentum-based indicator, and momentum tends to change before price does, before price direction anyway, the stochastic likes, the stochastic can somewhat disagree. It kind of leads a little bit as to what the market would tend to do based on momentum. So since we are peaking and going downwards with our price, and stochastics is pointing upwards, that is a clear divergence area, and price tends to follow stochastics. So if you'll see, we've actually been coming down. Stochastics is moving upwards, so the market tends to move in the direction pointed to by stochastics. So that's a bit of an advanced technique, but I'll use that to show you that stochastics is really good in leading the market, and actually kind of shows you beforehand what's going to happen in junction with the trend. The way that we're going to employ stochastics more with this type of strategy, though, is you'll see, go ahead and get rid of this, you'll see that there are two lines above and below in the stochastic window. We've got a line at 80 and we've got a line at 20. And you'll notice stochastic goes from 0 to 100. So there are times when the stochastic is above 80 and below 20, and we call that overbought and oversold. And basically what this is saying is that momentum and price have reached a certain area where they've pushed too far in one direction too quickly. And usually this results in the stochastic wanting to pull back toward the middle. Think about it like an overstretched rubber band. Stochastics wants to pull back into the middle, which is momentum pulling back. And remember, it likes to lead price, so price and on general tends to follow suit. So if you're in an overbought area or an oversold area, you always look for it to go in the opposite direction. Okay, now that we've learned just a little bit about stochastics and what it can do, let's employ a couple of the techniques that we've learned in order to identify trend direction. And we'll use stochastics to get into the swing highs and swing lows of the trend in order to ride them down or ride them up respectively. You'll see I have a 39 exponential moving average applied, and this 39 exponential moving average, is, if you remember, is it's a moving level of support and resistance. You'll see that there are times when the market comes up to touch this level and it pulls back from it very quick. Or if we come to the upside, it becomes a level of support. The market likes to touch this level and pull back. So the 39 exponential moving averages does a very good job of having a moving sort of trend spotting effect to it. So in this situation, if we're going to be below the 39 period exponential moving average, then we're going to assume that the market is heading downwards. This is basically a trade filter, if you will. So we'll say the market is heading downwards, and so we'll be looking for short trades only, because remember, and at least in this situation, the trend is our friend, and we're going to be trading with the trend as much as possible. Okay, so moving right along, we can employ some of our techniques, just like this, to determine when a trend line or a trend channel should be drawn. If you remember, we have a level of resistance here and a level of resistance here. Now it's not 3 points like would be very strong, but it's 2 points, and it's definitely enough, especially when we're rotating and turning toward the downside. You know, we're switching directions. It's quite a bit to 2 points at least is quite a bit to let us know that we're moving. We're beginning to move in the downward direction, especially since our price is now below the 39 exponential moving average. Okay, so we're moving right along, and remember, we're keeping in mind that we want to be taking short trades now. Okay, we want to be taking short trades because we're in a downward trend, and we're going to attempt to use our stochastics to sort of pinpoint our entry. Well, since the stochastics likes to move back toward the middle line, or the 0 line, if you will, we can actually, or excuse me, 50 line would be the middle of the stochastics because it goes from 100 to 0. Since the stochastics wants to move back toward the middle line pretty much all the time, we know that if we're over the 80 line, then momentum is saying it's moving too quickly, it's going to pull back toward the middle. All right. And if momentum is below the 20 line, then momentum has shifted in that direction and it wants to pull back toward the middle and would pull price up. So a good way to use stochastics for entry in a swing trading scenario would be when we've got our downtrend established, our price is below the 39, which is another confirming factor of our downtrend. What we're looking for is we're looking for the stochastics to go above 80, in which it does in this scenario. We also came back up and we hit our level of resistance up here, as we were talking about before, which is a very good way to determine entry, especially in swing trading situations. Because remember, the definition of swing trading is we're catching these swings, and we want to do so in the direction that the market is heading. and stochastics is now above 80. Okay, so this is a prime setup for a nice swing trading strategy from 4-hour daily or weekly setup. So now that our stochastics is above 80, we know it's going to want to head back down towards 50. We've got our trend lines drawn and established. Our level of support has been hit a number of times, and our level of resistance has been hit a number of times. And we see our stochastic, this red line here, which is the stochastic signal line, is crossing above the actual stochastic line, which is the aqua line here. So now we're heading back below 80. We're below the 39 moving average, and we've got our downtrend. So this would be a prime example of a short entry. And as you'll see, as we move it right along, and remember, each one of these candles is about 4 hours worth of time. So this ends up being a fairly quick swing trade, but everything lined up pretty well perfectly to let us know that we were heading back toward from the top back toward the bottom. Because if you remember, what we try to do, especially in trend defining and channel trading, is if the channel is very well defined and we have oscillators such as stochastics and our moving averages letting us know that we're underneath it and we're still good to go, that we want to ride this short as long as we possibly can. Because if you'll see, it actually goes down far enough to puncture below this level of support. So knowing what we know about trend lines, we know that trend lines tend to have the effect of becoming, if they were support, becoming resistance. So if they're punctured, they usually like to come back, as people are taking their profits and things of that nature. The price likes to come back and at least touch the line before continuing in its direction. Well, something very telltale about this move is we've got a very large move, but the fact that it is already pointing down and we're pushing down further below these channels is it's going to become, and as stochastic shows, it becomes in an oversold condition very quickly. We move down extremely quickly. So it would be an easy bet to say that at least, just like this, the price was going to come back up and touch our level of support, which would then become resistance. At that point, if we're in our short, we would be looking to get out of this trade. Um, and and more advanced money management techniques and things, it's called scaling out. If you say enter a standard lot at the during our entry point here, if you enter a full standard lot, it's whenever you get to the other side of the channel, which should technically be your target, is the other side of the channel. Just kind of following with the thrust and the pullback of the trend, then we should be exiting most, if not all, of our position here. But if you use a scale out technique, you can actually exit maybe 80 or 70% of your position and then let it continue until your area of support becomes your area of resistance, and then go ahead and exit the trade completely. Because since we're in a down trade, or yeah, excuse me, since we're in a downtrend and we actually broke down and our stochastic is in an oversold situation, there's no real sign to say that this move will continue downwards, even though it very well may. Um, Everything that we're looking at here, and especially since we've got as many pips as we did from that one particular move, it would be a very good time to exit this swing trade, because remember, swing trades are all about trying to grab just that specific swing. You're not necessarily looking to what's called long-term trend trading, where you just hold on to the trend regardless of the ebb and flow for a very long time. Swing trading allows you to grab these little swings, but if applied to a larger time frame, like the 4-hour, the daily, the weekly, or even the monthly, if you're so bold, um, you actually catch these swing parts here, and that's really all we're interested in whenever it comes to trading with this style. Is this downward move, and the direction of the trend that we've established with the confirming indicator and stochastics to back up our entry. Okay, now moving forward and expanding on the same principle, we can actually take the information that we've learned and apply it to a breakout system. And breakout systems are usually done on smaller time frames. They can be done on larger time frames, but breakout systems are generally encompassing price using support and resistance and finding a level at which, when broken out of, presents itself an opportunity to trade in one direction or the other for either a quick profit or at least the basis or beginning of a longer term trade. Now, whenever I trade breakouts, one of the main things that I look for is the market to consolidate or to move sideways without any discernible direction. Uh, you know, whereas swing trading, you look for trends, and then you attempt to trade the swings on those trends on a longer time period. Breakouts, you kind of drop your time frame and you're looking for the market to be completely moving sideways because, as we know, the market tends to trend both long term and short term, so it can't technically move sideways forever. So if we locate one of these areas where it's moving sideways using the information that we already know, then we can use support lines and resistance lines and a couple of extra indicators to kind of help us to put this all together and jump into a nice breakout trade and ride it for some profit. So there are a number of different things that you can do in order to tell you that you're in a consolidating market. One of the ones that we've already been over is using support and resistance levels in order to determine that we are indeed moving sideways. Now here's a pretty good example. This is the U.S. Canadian currency pair. I'm on the 30-minute chart, so I dropped my time period down quite a bit. And see, this sideways action right here is pretty well exactly what we're looking for. There's a smaller degree right here of it happening, right here in the middle. It's after a pretty big drop down. Um, what you're basically looking for is this, and this one's really dirty, so we're not technically going to use this, but you'll see the basic premise behind this is the fact that we're looking for the market to be unsure of itself, to be consolidating sideways. You draw a line, support and resistance, to kind of encompass the entire the sideways movement, and you're looking for a very strong fundamental reason for it to break out one direction or the other. Either a big news announcement's coming out, some sort of non-farm payroll is a big one for the United States. It's could be a number of different issues, but what we're looking for is basically an indecisive market and then a direction decided all at once. That's what makes a good breakout trade. So keeping with this, we've got our line of support and our line of resistance. We've actually got one area that looks a whole lot more like what we're looking for, and that is right here. You'll see that we have 3 hits on the top that are very close to each other. The wicks are very large, which means that we are in a situation where the market tested and immediately pulls back. And here, especially when encompassing price, when drawing lines of support and resistance, um, all we're looking for is a consolidating market. We're not necessarily looking for it to exactly touch the line and pull back, but the fact that these candles don't close above or below, obviously talking about from about this point forward, the candles don't close above or below our encompassing price. So we know that this is an extremely good setup. This is something that we're definitely looking for. Something else that you can do is use what's called a Bollinger Band. And these are generally used for identifying trends, but if you actually have a Bollinger Band set to a high enough level, you can see exactly when everything flattens out and begins to quiet. So I'm going to go to insert an indicator, and I'm going to put it at a 50 period Bollinger Band, which is rather large, but you'll see, like in times of trends, that the Bollinger Band likes to follow the trend, and that gives it a pretty defined direction. But in times of consolidating sideways markets, the bands become closer to price. Price likes to kind of jut above and below it, and this middle line is very flat. It might have a listing direction, but it's a very flat scenario. So we've got a lot of confirming things here. We know we're not in an overall trend. We've broken any sort of support or resistance line, which could be drawn technically here. Um, that's already been broken. There is no defined direction in any of this. So right now, we're looking for a break above this line or a break below this line. Now, usually, the big pop that you would get when looking for a breakout trade is generally something that is predictable. And by that I mean it's a economic news release. Like for example, this is the U.S. Canadian. So what I would do is look up an economic calendar for both the United States and for Canada for the times that are coming up and see if there are any big news releases that the market and the market players are waiting on, which would explain why the market is moving sideways like it is. So now that we've determined our sideways market, we've got our level of resistance and our level of support, then we would, in this case, since we have a smaller time frame, but still the distance between the two is rather large. That's still an 80 pip difference between the higher and the lower, which is a little bit more than what I would generally look for, um, especially on a 30-minute chart. But nevertheless, it's definitely a setup worth taking note of. We'd be looking for a pretty generous pop in one direction or the other. Now, with breakout trades, you don't necessarily wait for the price or the candle to close above or below, okay? But you want it to break by a certain percentage to avoid false breakouts like this one right here. I generally like to go for a percentage. See, this is an 80 pip box here, 80 pips from high to low. What I'll look for, especially in something this big, is between the 12 and 15% break of the box, which would put it at right around between 10 and 12 pips break. So we would take this line here, which is 1.10416, and we would take it down, about 12 pips or so to at the maximum, 1.10296, which is about 12 pips, um, depending on, see, at this point, we've already had this false break here. You might even want to lower this line to that point. But since we've got, more lines touching it here, it's a stronger support line here. So just give it a bit of a buffer, have it at least break down below this point before continuing or before deciding to make your trade, and also do the same up here. So it gives you a nice little buffer to make sure that you're not getting in any sort of false trades, and continue watching this until you get to those levels. Now you can put pending orders above and below here, which would basically say as soon as the market hits the specific price, and go ahead and enter. And that's a completely fine thing to do, especially if you are in a tight range and you know you're not going to be behind your computer, but everything seems to be lining up for a good trade. Now, before the trade is placed, it's very important to note that breakout trades, by their very nature, break out in one direction or the other. And this generally means that traders like to start to take their profit really early, or you have a whole load of traders that try to jump in on a big move. And what this will do is it'll actually slow the specific move down, especially if the sideways market is something that looks quite predictable, something like this. So a good rule of thumb with a breakout trade is to keep a really tight stop loss after your breakout, and especially once it gets down to a certain point. I wouldn't put a tight stop loss on it immediately, because the very nature of a quick breakout, it might move back and forth pretty quick, especially during a news announcement. But once you cross a certain threshold, basically what you're looking for, about 20 or 30 pips, go ahead and move your stop to break even pretty quick. That way, if it does come back on you, um, all the people getting in and taking their profit and stuff isn't going to turn what is potentially a good breakout trade into a false breakout and have you in a losing position. So in this scenario, we actually keep moving forward and we find our pop. And this pop actually ends up jumping down quite far below where our buffered entry point would be, and ends up going to a low of, about 50 pips, and the candle ends up closing at about 34 pips. So at this point, I would definitely move to break even, and probably break even plus some, so I'm not out anything if the market continues to thrash around and come back and take me out. But this would definitely be a defined breakout. Now, whether or not it's going to start a new trend or not, that's kind of up in the air. It really depends on the news release and the fundamental factors behind the breakout. But um, by going ahead and moving your stop or your stop loss to break even, and kind of seeing what this breakout does, letting it run, maybe break even plus about 10 pips or so, there is a chance that it could, like in this scenario over here, begin a nice downward move even before it begins to consolidate again. So you want to ride that as much as possible. So a trailing stop is a very good thing to do in a breakout scenario. But remember, um, let the thing move a little bit before you start moving your stop aggressively. Let it kind of work out of what it's going to do. Because as you see here, it pushes down a little more, but people begin to take their profit. It begins to move back toward our entry point rather quickly. So this particular breakout could have had us, at a absolute maximum of about 67, 68 pips without spread. Whenever you get to this third candle, which is actually a reversal candle, as we were talking about before, um, you're still sitting around 39, 40 pips or so, which for a popped breakout trade is actually quite good. Again, it could turn into a long trend, but that's what your swing trading strategy is for. This is something that has a potential to break out and grab some pips pretty quickly. And remember, just keep your tight stop, or keep your stops tight, and kind of protect yourself on these type of moves. So that covers the shorter term aspect of the breakout trading, and then we have the longer term aspect of the swing trading. With all the stuff that we've learned, such as identifying trends, identifying lines of support and resistance, knowing our candlestick patterns when things are beginning to slow down, um, uh, what we've learned with stochastics and things like that, you can take these two different strategies, which are, pretty different from one another, but both have their strengths, and you can employ the very basics of what we've learned, the very foundation of any good Forex trading system, spotting the trend, support and resistance, stochastic oscillators, and using indicators that are pretty widely available, such as moving averages as moving lines of support and resistance, to have a couple of different ways to pull some pips out of the market in a pretty steady fashion, all backed by technical analysis and fundamental analysis to boot. Really rounds out to an awesome way to trade. Now, there's one other aspect that many people tend to overlook with trading, no matter what the system is, and it's money management. And I know a lot of people groan when they hear that. A lot of people are really addicted to getting in at the right time, getting out at the right time, and pocketing as many pips as possible. But in situations like this, even with this little move, there are chances that you could actually make more doing this somewhat safely than you could in your longer term swing trading. And it's all about position sizing, and it's all about how you handle your stops and your take profits. So in the next video, we're going to go ahead and talk a little bit about that, and we're going to see how it's possible to pull out as much money as you can from the smaller trades. By knowing ahead of time what you're looking for, you can pull as much money as you can out of these smaller trades. You could tone down your risk on the bigger trades, and you could actually, if you believe this or not, be in a situation to where over a series of trades, you're actually negative pips, but you're positive dollars. It's all in how you handle your money, and it's all about your money management. So we'll go ahead and jump into that in the next video.